ESG integration must be adapted to the characteristics of each asset class because investment objectives, ownership rights, valuation methods, and risk exposures differ significantly. While the core principle remains the same, identifying and incorporating material environmental, social, and governance factors into investment decisions, the specific analytical techniques vary across equities, fixed income, sovereign debt, private markets, real estate, and infrastructure. Investors use ESG analysis to enhance risk assessment, identify opportunities, improve valuation accuracy, and support stewardship activities. The CFA Sustainable Investing Framework emphasizes that although material ESG factors are relevant across all asset classes, integration techniques must reflect the unique features and information requirements of each investment category. In listed equities, ESG integration is generally the most developed and comprehensive. Equity investors combine qualitative and quantitative ESG analysis with traditional financial research to assess competitive positioning, management quality, risk exposure, and long-term value creation. ESG factors may influence earnings forecasts, cash flow projections, valuation multiples, and discount rates. Investors often use ESG scorecards, company disclosures, engagement activities, and proprietary ratings to evaluate issuers. Because shareholders possess voting rights and direct ownership interests, stewardship and active engagement play important roles in the integration process. Listed equity markets also benefit from relatively high levels of disclosure and transparency, supporting more extensive ESG analysis. In corporate fixed income, ESG integration focuses primarily on creditworthiness and repayment capacity rather than upside growth potential. Bond investors assess how ESG factors may affect balance sheet strength, cash flow stability, default risk, and credit spreads. Environmental liabilities, governance weaknesses, labor disputes, and regulatory risks may all influence an issuer's ability to meet debt obligations. ESG scores are often integrated into internal credit analysis frameworks alongside traditional financial metrics. While equity investors may focus on growth opportunities created by ESG initiatives, fixed income investors are generally more concerned with downside protection and preservation of capital through effective management of material ESG risks. Sovereign and municipal debt require different ESG approaches because the issuer is a government rather than a corporation. Investors evaluate governance indicators such as corruption control, rule of law, regulatory quality, political stability, transparency, and institutional effectiveness. Social factors may include education levels, healthcare quality, demographics, and human development indicators, while environmental considerations may focus on climate vulnerability, resource management, and infrastructure quality. These factors influence economic growth, fiscal sustainability, and long-term creditworthiness. Investors often use sovereign ESG scoring frameworks and macroeconomic indicators to assess country-level risks and opportunities. Applying ESG analysis to sovereign debt is more complex because materiality differs substantially from corporate investments. In private equity, private debt, real estate, and infrastructure, ESG integration often involves greater direct influence over assets and management practices. Private market investors may establish ESG key performance indicators, KPIs, governance structures, reporting standards, and sustainability objectives early in the investment lifecycle. Real estate investors frequently evaluate energy efficiency, carbon footprints, environmental certifications, tenant relationships, and resource management practices. Infrastructure investors assess long-term environmental, social, regulatory, and operational risks. Frameworks such as GRESB provide benchmarking tools that measure management quality, disclosure practices, environmental performance, and sustainability targets. The ability to exercise direct control creates opportunities for deeper ESG integration than may be possible in public markets. Across all asset classes, investors employ common ESG integration techniques including materiality assessment, scorecards, scenario analysis, risk mapping, proprietary ratings, engagement activities, and valuation adjustments. However, the weighting of ESG factors, data requirements, analytical frameworks, and investment objectives differ significantly depending on the asset class. Equity investors emphasize growth and value creation, bond investors focus on credit risk, sovereign investors assess macroeconomic and institutional quality, and private market investors often prioritize operational improvements and direct oversight. Successful ESG integration therefore requires both a consistent analytical philosophy and asset class-specific methodologies that appropriately reflect the risks, opportunities, and ownership characteristics of each investment type.